Imagine you're buying a used car. You see a beautiful sports car with a flawless, gleaming paint job, and you buy it on the spot. But 10 miles down the highway, smoke pours from the engine, and you are completely stranded. You bought it without ever looking under the hood. People make this exact mistake every day in the stock market. They see a stock's price shooting up, the shiny paint job, and they buy in without ever checking to see if the actual business is functioning. That is where reading the market comes in. It's a way to see the full financial picture before you commit a single dollar. You do not need an advanced finance degree to do it. You just need everyday common sense and a systematic approach. Before you put your hard-earned money on the line, you have to run through a simple checklist. You inspect the car's engine, which is the company itself. You negotiate a fair price, known as valuation, and you check the driving conditions, the broader economy, and global events. Let's start with the inspection. When you look under the hood of the company, you are looking at its financial statements. These are the official, heavily regulated documents that prove how healthy the business really is. The first document is the income statement. Think of this as the car's engine. It tells you if the business is actually generating forward motion over a period of time. It tracks the fuel going in, the total sales or revenue, and subtracts all the costs of running the business until you are left with the final profit or net income. Next is the balance sheet, which acts like the car's structural frame. It takes a snapshot of the company's stability on a single day. On one side, it weighs everything the company owns, like cash and factories. On the other side, it weighs everything the company owes, like loans. If the debts are too heavy, the frame is at risk of snapping. Finally, we have the cash flow statement. This is your gas tank. Sometimes the income statement can look profitable on paper because of accounting rules, but the cash flow statement cuts through the noise. It tracks every single dollar of hard cash actually flowing into and out of the company's bank accounts. If the tank is empty, the car isn't going anywhere. Attached to all these reports are the footnotes. You will find crucial details hiding in the fine print. Things like exactly how the company accounts for its money, or hidden debts that aren't obvious in the main numbers. Never ignore the footnotes. They are your best defense against bad information. When you read the income statement, balance sheet, and cash flow statement together, you get the complete truth. You protect yourself from buying a company that looks great on paper, but is quietly breaking down in reality. Now, let's say you found a great, perfectly healthy car. If the dealer is asking $1 million for a standard sedan, it's still a terrible deal. The same is true for stocks. Even a fantastic business becomes a bad investment if the price tag is wildly inflated. To figure out if a stock is cheap, expensive, or fairly priced, we use valuation ratios. These act exactly like the Kelley Blue Book for a car, giving you a reliable estimate of what the business is actually worth. The most common tool is the price-to-earnings, or PE ratio. It's a simple calculation that compares the stock's asking price against the actual hours the company brings in. If the asking price is towering over a tiny stack of actual earnings, you are paying a massive premium. For decades, the most successful investors have relied on this disciplined approach to valuation. It requires you to base your decisions on math and clear metrics, rather than following the emotions of the crowd. Using valuation ratios creates a defensive shield around your money. It forces you to pause and verify that you are getting real, tangible value for every dollar you spend. So you have a great car at a fair price. Now we have to pull out of the garage, because even the strongest engine will struggle if the road it's driving on is collapsing. In investing, the road is the broader economy. To understand the road conditions, we watch 3 major indicators. The first is gross domestic product, or GDP. Think of this as the overall speed of traffic. When GDP is growing, the entire national economy is expanding, making it much easier for your company to move fast and make sales. The second indicator is the unemployment rate, which tells us about the other drivers on the road. A low unemployment rate means more people have jobs and money in their pockets. That consumer spending is the fuel that keeps businesses running. Finally, this chart shows how inflation acts like a sudden spike in the cost of gas. As the line for inflation goes up, you can see the bar representing consumer purchasing power shrinking dramatically. High inflation eats away at everyone's wallets, often forcing the national banks that control the money supply to raise interest rates to slow the entire economy down. By tracking GDP, unemployment, and inflation, you gain the context you need. You'll know whether the economic environment is acting as a strong tailwind pushing your investments forward or a harsh headwind holding them back. There is one final element on our road trip: the weather. Major international events like sudden trade disputes, unexpected election results, or international conflicts are like violent thunderstorms that roll in without warning. Financial markets hate one thing above all else: uncertainty. When investors can't see through the fog of a new global event to predict how it will impact supply chains or profits, they get nervous. This nervousness often triggers a flight to safety. Instead of waiting to see what happens, people panic and sell off their stocks, moving their money into safer havens like government bonds or gold until the storm passes. You cannot predict when these storms will hit, but by building a well-diversified portfolio of financially stable companies, you give yourself the traction needed to grip the steering wheel. You can confidently drive straight through the bad weather without feeling the urge to panic sell. A systematic checklist turns the noise of the market into a manageable process. Investing becomes a series of objective tests rather than a series of guesses. Before you buy, you run the list. Step 1. Inspect the financials to make sure the car runs. Step 2. Check the valuation to ensure the price is fair. Step 3. Scan the economy to see the road conditions. And Step 4. Prepare your portfolio for unpredictable weather. By looking at every layer of the market, from the gas tank to the road itself, you leave the surface-level hype behind. You are analyzing companies the way professionals do. As legendary investor Warren Buffett has noted, price is what you pay, but value is what you get. Knowing how to read the market is the only way to guarantee you actually receive the value you are paying for.